Hello, everybody. Welcome to Sticky Notes. This is our fortnightly talk series where folks that use a story basically share things that are interesting about product design, user research, or startup culture, industry, that sort of thing. It's our kind of internal learning platform made public. I hope you enjoy it if you are watching along online. It's actually very quiet in our office today. We only have one other person here who is our newbie, Steve. So I know you can't see him, but say hello to Steve. Hi, Steve. Thank you, Steve. So if you enjoy this one, do check out our YouTube channel where you'll find lots more videos all about all sorts of things like design ethics and semiotics and all sorts. I hope you enjoy this one. So today I'm going to be talking about the weird and wonderful world of startup terminology. And although I aim to make this as interesting as possible, despite the sometimes a little bit sort of bland nature of this, I've asked an AI to create all of the pictures for me today, including this one, which they're all rabbit themed today. I've basically asked it in various different styles to give me, lots of rabbit imagery. I hope you enjoy them. I'm not sure why, but I just felt like it was, rabbits in various different artistic styles kind of made the whole thing a bit more palatable. But let's see how we go. So let's talk about terminology. The first thing to note about startup terminology in particular, but most terminology in most. Oh, hang on. That's in that case. Hang on. The old slides on, that would help, wouldn't it? And there we go. There's our first rabbit slide. Hope you enjoy it. It was worth it, right? So yeah, let's talk about terminology in startups. In particular, what I notice about terminology in most industries, but particularly in the startup industry, is how many acronyms there are. There are so many, and I think if we concentrate on, we're going to have a look at lots of different terms in startups today. I'm going to try and break down a couple of different acronyms. But I think it's worth remembering that as much as possible when we're talking to people about, things in our own industry, people outside of our industries, that we try and not use acronyms, because actually acronyms across industries can mean very different things. We're going to come across a few today, which you'll probably recognize, but they might actually mean something different to you, to other people. So yeah, we should take a moment to recognize that. Basically, oh my God, for goodness sake, so many acronyms. But the ones that I want to concentrate on today are these. So these sorts of terms you might have heard quite a lot when you're talking about startups, and when you hear about startups, you might hear about these sorts of terms in the news, or when you're talking to people perhaps that are running startup companies. And a lot of these things, unless you actually know really what they mean, are just gobbledygook to most other people. So I'm going to try and break down these terms. But if you have any others that you're a bit confused about and you're not sure about, and things that I don't mention today, then just shout. So at the end of the session, I mean, Steve, you're the only one in the room. So if you've got questions at the end, then you can ask and I'll answer them. But obviously, if you are at home, stick them in the chat. If I can get to them at the end of the session, I will. But if not, we'll try and reply in the comments. Or you can always DM us afterwards, and I'll explain anything else you might like to know. So looking at these words, some of these you'll have already heard, but most of these are basically about money things. They're just different aspects of money raising, or different sized, startups at different points where they're going to be raising different kinds of money. And so the first one we're going to talk about, though, other than the money stuff, the first things we're going to talk about are things that actually relate to a startup at any point within its journey. And the first one is MVP. And we hear this one quite a lot. MVP, which stands for minimum viable product, or sometimes minimum valuable product. And the idea behind an MVP, minimal viable product, is you want to have enough features to validate a concept. So it's the version of a new product that allows a team to collect the maximum amount of validated learning and information about their customers or their target market with the least amount of effort. So sometimes you'll hear an MVP, which basically means all of the features that we want, or it's the basic features that we want, or it's the starting features that we want. And that's not necessarily the case. An MVP should be, we want to learn as much as we can by building as little as we can. The next one is equity. all the way through a startup's life, you're going to hear this term. And you might also hear the term sweat equity, which is what this rabbit is doing. Sweat equity and equity, so equity, first of all, is basically the value of shares. That's roughly what it means. So if you have equity in a business, what it means is you have a share in the business. So let's say you have 100 shares that are available in a business. You could have equity worth 20% of that business, which would mean you'd have 20 shares. And that's basically what it means. And a lot of the economics around startups actually comes down to equity, how much people earn. And when you put money into startups, most of the time, what you're looking for is equity. You want to own a bit of that startup so that you can own its success as it grows. Sweat equity, which is something that you also might have heard of, is generally applied when people get into startups really, really early. And it's because a lot of those startups don't have an awful lot of money and they can't really pay people a lot of money to actually get working on that project. So what they do is they ask for sweat equity, which is where they put in the sweat, they put in the hours, they put in work to try and make that startup happen. And get it to that next stage of perhaps next funding or whatever it is they're trying to achieve. And in return, they get a bit of equity. So they're putting in their time and effort and they're actually getting equity. They're getting share in the business back. That's sweat equity. And then the last one that applies basically across the board is this one, which is term sheets, which is something that, again, it might be a little bit less known one, but a term sheet is basically terms and conditions. If you're actually about to get shares in a company or you're about to do some work with a startup or so on, there might be a term sheet. And a term sheet is basically, if you get these shares, these are the terms that apply. This is what happens with those shares. That's the basics of it. We won't go into all the detail, but that's the basics. So let's have a quick look at a startup's journey. So this roughly is what the journey of a typical startup might take. And obviously this differs for every single different kind of company, but this is roughly what it might look like. And some of these terms you'll probably have heard of, but actually, what do they mean? We've got pre-seed and seed, which again, you might hear the terms seed round or seed funds. You've got Series A, Series B, Series C, and so on. Hear lots of those as well. And even the term IPO. And these basically are different stages of a startup. We'll come back to them in a second. But what is also interesting is the kind of funding that you might want to be getting at each of those different stages. So at pre-seed, you might be looking at friends and family funding or maybe angels. At seed round, similar sort of thing. You might be still looking at friends and family or angel funding, crowdfunding, or you might even be looking at something like an accelerator. We'll go through these terms in a second. And then as you start to grow and get bigger at Series A and onwards, you're probably looking at things like venture capitalists or in private investment, more crowdfunding, and eventually onto hedge funds and banks and so on. So let's get into these a little bit deeper. The first thing is, regardless of which of these stages you start at or what kind of funding you're looking for, what you're aiming to achieve is product market fit, or sometimes the acronym is used PMF. What that basically means is that your customers are buying your product in large enough numbers to sustain your growth. It basically means you've got a business that's actually making some money. You've achieved product market fit, means you're actually selling enough that you can pay your wages, you can pay for your premises, you can, essentially the business is wiping its own face. In the early stages, PMF is really important. So particularly at the seed stage, what you're trying to do is convince people to give you more money because they know that the business is going to work. So if you can achieve product market fit, that is a really good sort of a proof of the startup's value, if you like, to an investor. So pre-seed and seed, these two sometimes are a little bit conflated and they are a little bit muddy because sometimes you don't have a pre-seed at all. And sometimes they are proper defined stages. But typically a seed stage is normally the first equity funding stage, i.e. people giving you money and you giving them a share in the company. Sometimes companies have a pre-seed round where they don't really know what it is they're trying to do yet, but they take in a little bit of money. It's typically from friends and family and people they can convince to kind of give them a bit to just try some ideas out to work up a concept or try something. And it's the stage where there's some market traction. You might have some people that are a bit interested in the idea and you've identified a problem in the market, but you need a little bit of cash to just test the water and see which approach is going to work and see if you can reach that product market fit. So typically the pre-seed is, we don't really know yet. We want to play around and see if we can find something. The seed is, we think we kind of have something. We just need a little bit more money to see if we can work out if we can actually achieve that product market fit. There you go. That's pre-seed and seed. At this stage, you might also get involved with either an incubator or an accelerator. And they're a little bit different, but very similar. Basically, they provide you with education, mentorship, financing on occasion, or access to people that may be able to finance your startup, and also things like co-working space as well. And we have one actually based in Norwich called Acceler, and they do exactly this. So they provide you with all the support you'd need as a startup to get it to the next stage, to understand how you're going to pitch this to investors, make it as valuable as they possibly can, give you co-working space, give you access to mentors, and put you in front of people that can finance the business. It's normally a fixed period, these sorts of programs, and they normally do it as part of a cohort. So they have like a fixed term where they say, we're going to take in a cohort on this date, we're going to end on this date. And at the end, they also have a demo. So they ask people to come in and see what these people have made. And, they'll ask, potentially investors, angel investors, and maybe even people from VCs and so on to come and have a look at what people have made. They normally will take a big stake in the company as well. So, it's normally between sort of 3 and 8% roughly of a company. But yeah, they'll take a bit of a stake in exchange for all of these services and advice. So incubators are normally very, very early. So they will take on startups at the really, really early stage. And accelerators, normally, they will take on businesses that have an MVP, that have already got something where they think they just need to tweak it a bit and maybe they'll achieve that product market fit. At this stage, you may also be looking at angel investment. And angels basically are people with lots of money who want to put a little bit of their money, their net worth, into companies in exchange for equity. So they want a little bit of a share, or actually quite a big bit of a share, because it's pretty risky at this stage, for giving you a bit of money just to see if an idea will work. And obviously this is pretty risky because they don't know how many of these companies are going to work. There's no real product market fit there. It might be that it's a bit of a stab in the dark, which is why they take such a big share of a company. But yeah, an angel investor is typically, they're called angels because they're doing it at such an early stage and it's such a big risk that they're likely not to see their money back really a lot of the time. So, they might be friends and family and people that or people through angel networks, that sort of thing. So once you've done that and you've achieved your product market fit, you're probably looking at a Series A next. So generally startups raise money at each letter. So they do a Series A round and then they do a Series B round and then they do etc. And it kind of depends on the stage and the development of the startup, but that's roughly what it means. So if you're doing a Series A, what it basically means is the first really big investment piece after you've actually achieved your product market fit and you know what it is that you're trying to build. You just want to scale it. You want to make it really big and see if you can make it the next big idea. So most angels and VCs will look at Series A because it's slightly less risky at this point. They already know that there's something that's gaining a bit of market traction. Some people actually now opt for crowdfunding, which we'll have a look at in a second as well, to help with their Series A. And that's it really. Each letter corresponds with a different stage of the development of the startup. And then most startups, if they're looking to go into the stock market, that's a bit later on. That's called an IPO, which we'll come back to. And that's typically after Series C. So when they've done a few big rounds, they then look at gaining lots and lots of money so they can really go big. And that's a bit later on down the line. But that's all those series mean, really. It's just A, B, C. It's just the order in which they raise money. And then, lastly, after the Series C, you might hear the term IPO. And that is an initial public offering, which means rather than offering bits of shares or equity to individual investors or to networking, investment networks or what have you, what they do is they actually offer it to the wider public. And that's where you create, you basically pop up on the stock market and people can access your shares on the stock market. This is usually for companies that want a lot of money. So they are looking for big scale. Some of the biggest companies in the world will do this sort of thing. So Facebook, for example, did this, a couple of years ago, where they reached the point where actually, they could access things like private funding, but actually it made a lot more sense for them to just go completely public and get everybody involved and raise huge sums of money. Cool. So along your series journey of fundraising rounds, you might come across venture capital or venture capitalist firms. These are basically big investment groups and banks that are speculating on high growth businesses. They think they've got a company that they think is going to be really big, and they take in lots and lots of investors' money into a big pool or a big fund, and then they basically give bits of that fund out to different companies. And that's basically venture capital. So if you don't have enough cash flow to take on a big loan, because lots of banks will obviously want to know that you can pay back if you take on a loan, that you're actually going to be able to pay that money back. Venture capitalists will be able to take a bigger chunk of your company. So they'll take a pretty sizable share or an equity share in your company, but they will give you lots of money on the proviso that hopefully they'll get that money back in the future through your shares. But actually, it's still a bit of a punt for them at that stage. So if you can't raise the money because you don't have the cash flow yet, a lot of companies will turn to venture capitalists. And then finally, crowdfunding. So particularly in those series of rounds, you might find that people going to crowdfunding, where it's a bit like floating on the stock market in that you open it out to lots of people, but actually it's basically private investing. People can buy a tiny little bit of a share of your company in exchange for a bit of money. So it's a good way that you can raise a fair chunk of money from lots of different people. But it's also a really good way of marketing your company too, because if lots of people share the problem that you're trying to solve, you can actually reach a whole bunch of people and give them a little bit of your company in return. That's why people tend to do crowdfunding. So back to that whole that flow, that's basically what the life of a startup looks like. There's a couple of terms outside of that as well. So you obviously may not need to raise any money at all, and you might be able to do it yourself. And that's what bootstrapping is. So if you bootstrap a company, it basically means you're doing it yourself. You're not taking on massive amounts of money from external investors. Lots of companies actually do this. So lots of cottage industry or sort of lifestyle businesses will do this sort of thing, where they'll have a little bit of their own money and they'll just try something themselves really cheaply and just slowly grow that thing. That's bootstrapping. And then the last one I wanted to leave you with is this word, which is a unicorn. A unicorn is basically what every startup probably wants to be eventually. A unicorn is any startup that is valued at $1 billion. So if you reach that $1 billion valuation because of the money that people are putting into you and the amount that a share is therefore worth, you can become one of these unicorns. There's not many. There's only about 1,000 now around the world. There you go. So that's all of the sort of basics of startup terminology. Hope you found that handy. There is one final rabbit picture because I just thought that was the cutest one ever. I think I literally did type in the cutest rabbit possible. So that's me. Any questions I was going to say anyone in the room. Any questions, Steve?
One question.
Yeah.
Are there any indicators for the different stages of the series?
Are there any indicators from different stages? So yes and no. It always depends on the startup. And generally, it's based on how ready those different people who could give you money think you are for that stage of investment. So at the Series A, for example, the indicator is whether you have achieved product market fit, whether you're actually making money, for example, whether you're revenue generating, that sort of thing. So there are a few little indicators, but really it's very malleable and it does depend on the startup. It depends on circumstance, depends on what funding they've already had, all sorts of different things. So yeah, yes and no, but it's normally from the people that are going to fund you. It's them that would have the indicators. They will be telling you the sorts of things to be looking for. And actually, if you work with an accelerator or an incubator, they will also help you. They'll say, these are the sorts of things that a company will be looking for at this stage in your development. So yeah. Cool. Let me have a quick look and see if we've had any on the chats. I haven't seen any. Okay, all good. Well, thanks very much. We will see you actually next week for the next sticky note, where Laurie will be talking about the passwordless future. So yeah, come along next Friday at 12:30 on YouTube, Facebook, LinkedIn. We'll see you there. Thanks very much for joining us.